Are you looking for steady dividend income now or explosive growth over time? Today, we're breaking down 5 top dividend aristocrats with strong dividend growth and showing what $50,000 invested in each looks like in 2 ways. 1, taking dividends as cash, no drip, how your income grows. And 2, reinvesting dividends fully, the full drip, how your portfolio and income snowball. So stay tuned. Welcome back to Simply Money. To be a dividend aristocrat, a company must raise dividends for 25 plus years. These 5 are true aristocrats with solid dividend growth. First, let's look at what these companies are, what their current yield is, what their 5-year CAGR is, as well as how many consecutive years they have raised their dividends, and what they'd be good for holding in your portfolio. First of all, we have ADP, Automatic Data Processing. Its current yield is only 2.5%, and I know for those who are into the high yield, they're going to think, I don't want to even watch this. But I encourage you to stay tuned to the end to see the power of the CAGR in these compared to some of these other high-flying yields that we talk about a lot that don't have growth in their income. I want you to see the power of this CAGR. The CAGR on this 5 years has been 12%. And ADP has increased their dividend for 49 consecutive years. So they have recurring revenue. It's a payroll giant. They have stellar dividend growth. So this is a great company to look at. We're going to look at some samples of how powerful this can be in a moment. We'll look at all 5 of them together. Our second company we're looking at is AbbVie. With a 3.9% current yield, it does have a higher beginning yield, but it only has a 6.5% CAGR. And I say only because compared to automatic data processing, it is low, but it's still a healthy CAGR and can have a powerful impact on your growth. They've increased their dividends for 50 consecutive years, and this is great if you're into the farmer cash flow, solid yield, and growth combo. This is a great company and has great history for you. Third company we're looking at here is ADM, Archer Daniels Midland, with a 3.3% yield, a 6% 5-year CAGR, and 50 years of consecutive dividend increases. It's a defensive agri-giant with steady dividends. This is a great diversification for a portfolio and has, again, great compounding power. Then we have good old Procter & Gamble, PG, with only having a 2.7% yield, but a 5.5% CAGR with 67 consecutive years of dividend growth. This is the ultra-reliable, inflation-resistant company. It's a great foundation in a portfolio. And our 5th company we're going to look at is GPC, Genuine Parts Company, with a 3.3% yield and a 6.5% CAGR. This also has paid 65 consecutive years of dividends with increases. This is a stable auto parts and industrial distribution. So with these 5 companies, you get a little bit of diversification in different sectors. You have nice CAGR growth and a healthy initial starting dividend. Again, don't let this dividend yield starting out fool you because we're going to see the power of compounding through the CAGR. So the first thing we're going to look at on the chart is no drip. How much cash income growth and portfolio value can increase not using a drip? Because it's important if you're going to be taking out the cash for income that you're able to at least maintain your portfolio balance, if not grow it. That's a great thing with these companies. You'll see that with no drip, we're going to still get growth even while we're using the income. Let's look at these 5 companies. We'll start with ADP. The current yield is 2.5% with that 12% CAGR. After 5 years annually with no drip, you could expect about $3,800 annually for your income. But your portfolio balance has also grown to $57,000. Over 5 years, you've grown your income and you've grown your portfolio balance. Over 10 years, that would grow to $7,900 income and $72,000 portfolio balance. So you're getting a steady increase in pay, your income is increasing, helping hedge against cost of inflation, and you're also increasing your portfolio balance at the same time. This is a great, strong company to pin down your portfolio and help hedge against some inflation. AbbVie, we have 3.9% current yield, 6.5% yield. You can see that in 5 years, you have $4,700. Your portfolio balance would be about $59,000. And look here, at 10 years, you're at $6,700 with a portfolio balance of $70,000. This is the power of the CAGR, and a lot of people overlook this. They might look at this current yield and say, well, I'm going to jump into this AbbVie because I need the income. I need more higher paying, this greater yield. And that's what you'll see when people jump into the high yield, like 10, 12, even 20%. They're chasing that current yield, which in certain circumstances may be beneficial. But if you're looking long term and you want to hedge against inflation, see the difference that even though you're almost 1.5% lower with ADP, after 10 years, you're actually getting more income and growing your portfolio more because of this CAGR. The CAGR is the power that we love. And that's why I talk about for ETFs, I love SCHD because it has a healthy starting yield and has a strong CAGR. And if you've never seen my videos on the portfolio growth of SCHD, check that out on the channel here. The third company we're looking at is ADM with a 3.3% starting yield, 6% CAGR. Your annual income at 5 years would be about $3,900 and $55,000 value, $5,400 after 10 years with $65,000 value. With Procter & Gamble, have 2.7% yield, 5.5% CAGR. You're getting that 5-year income at $3,400 with a $58,000 balance. And then we have at the 10-year income of $4,600 with $68,000 portfolio balance. That brings us to GPC, 3.3% current yield, 6.5% CAGR, $3,900 income after 5 years with $57,000 balance, and $5,500 at 10 years with a $68,000 balance. Now that is no drip. That means you've been getting this income from day one. Annually, it is increasing, and by 5 years, this is where you're at, and by 10 years, you're over here at the 10-year annual income. It's a great way if you're needing cash now, but you're also wanting to hedge against inflation to begin taking in some cash flow. The second chart we're going to look at is full drip. This is your total portfolio value and hypothetical income if at the time, say 5 years or 10 years, you say, now I'm going to start taking this income, where would your income be at? Let's again start with ADP, or skip by, you get your yield and your CAGR. But at 5 years, you're looking at a $72,000 portfolio balance with $4,350 as your income. And if you waited 10 years, that balance would be up to $130,000, and you're looking at $11,200 of income. That initial $50,000 investment, if you didn't touch it in 10 years, would be at $130,000, and it would be generating you almost $11,200 per year off that $50,000 with continual steady growth. If you were to shut that drip off here and start using that $1,000 a month almost, you're still going to get that continued CAGR growth. Your income will increase over time. Okay, then we have AbbVie. We have a $75,000 balance with $5,200, and then $110,000 at 10 years with $8,600. Again, here you really see the power of that compounding of that CAGR, the 12% versus 6.5%. At 10 years, when you see that ADP is up to $11,200 versus $8,600. Both are really strong, good, consistent paying companies though. Okay, ADM, we're at $70,000 with $4,500 at 5 years. $100,000 with $7,800 at 10 years. Procter & Gamble, $65,000 at 5 years. $4,000 income, or $90,000 at 10 years. With $6,300 income. And then GPC brings in at $70,000 5 years, $4,600, and $105,000 at 10 years with $7,800 annual income. Now again, this is based on past performance. Past performance does not indicate future performance. This is for educational, informational purposes only. This is not financial advice. I'm not telling you to buy these companies or not buy them. Just showing you the power of the CAGR and the current yield and how that can compound with the drip or the non-drip. So no drip means you take dividends as cash. Your income grows by dividend CAGR, but portfolio value grows only by price appreciation, assuming roughly 3% per year. The full drip means you reinvest dividends, buying more shares. This compounds your portfolio value and growing income exponentially. So drip is a great way for income needs down the road to build that income stream. These projections simplify real-world volatility and taxes, but show the power of reinvestment. So we're not giving tax advice. We're not breaking down how much would it be with or without taxes, whether you have it in a Roth or regular IRA, whether you're getting qualified or unqualified dividends, what your income level is, what state you live in. There's so many diversified answers to that we don't get into that here. Your taxes will be different, and you'll have to figure that out based on all of your circumstances. If you want to build real wealth with dividends, think beyond yield. Look for dividend growers and consider reinvesting your dividends to turbocharge growth over time. Want me to model your portfolio this way? Drop a comment down below. Let me know what you'd like to know about, what you'd like to see. Put those stocks in there. Give me price ranges that you're looking at per stock, and I'll go ahead and run some scenarios for you and do a video and give you a shout out with it. Do you own any of those 5 companies? If so, why? Why not? What is your reason behind it, and what are your goals with it? If you enjoy these types of videos, don't forget to hit that like and subscribe button, and we'll see you next time on Simply Money.